a negative impact on your bond rating. But it's important to know that this is not a funding requirement, it's a reporting requirement. So you're in the same boat with a lot of people, and right now the rating agencies have said, we don't know what we're gonna do with this. We don't know if we're gonna penalize towns for having not funded it, or whether we're gonna do it. It's information for us right now. But if eventually, if other places are doing some funding of it, you'll suffer by comparison. And when they compare you to a similar, someone who, if you in another town both had the same bond rating, and they start funding it to some extent, and you don't, then eventually they have to do something. They have to say, well, they're both not the same anymore. We have to raise them or lower you. So I think it's gonna be the latter. Until recently, there wasn't, even if you did want to fund it, there wasn't a mechanism that could qualify as a real plan. And that means it had to be irrevocable to be considered a plan. And the Massachusetts legislature enacted Chapter 479, which established it requires town meeting approval and allows you to have a plan, to put an irrevocable plan to put funding in. So we recommend that the first step is to accept the plan, accept Chapter 479. I've been involved in a couple of calls with Moody's and Standard & Poor's lately with some bond rating calls. And even as a first step, they were happy to hear that people had accepted the plan, even though they hadn't funded it. They said, well, that's a good first step, because this is the first year you've even had the liability on your books. So I think it's a good idea to be able to say during a bond rating call, well, we accepted the plan, we have planned to do what we can about it. And, because this, in my experience right now, there's three groups. There's communities that are funding it in its entirety. Those are just, excuse me, small towns that don't have any regional schools, that only have regional schools, so they don't have any teachers, so they're very small, and they might have a couple $100,000 annual required payment, and they're funding that. And they feel pretty good about it, and they should, but if the regional schools that they're affiliated with said, you know what, that's a great idea, we want to do the same thing, they couldn't do it, because all of a sudden they'd be up to the $3 million number, just like $2.7 million.
Explain something to me then. Annually, we fund in our budget amount for county retirement.
Yep.
Right.
Yep.
So if we had fully paid this unfunded liability.
Well, this is health insurance.
Oh, this is only health insurance?
Just health insurance, retirees' health insurance.
Okay.
But
it's a large number.
It's a very large number. I've looked at it, and I compared it to some places that are similar size, and it's significantly higher. It's an actuarial study, and they make certain assumptions. And a big assumption, I'm sure, is that the Section 18. That's a key. They also have like a range of percentages that they can use for how much your investment earnings are going to be, between 4% and 6%, I think is what they're allowed to use. So it depends on what they use, and I think they used a lower percentage, but a 4 or 5% as a
So let me go back to the question then. If that was fully funded,
yeah,
right, then we would not be funding in our employee benefits budget annually for the retirees' health insurance.
What you would be funding is for the current employees.
Current.
Right, exactly. Yeah. So
current being
the people that are working right now.
Currently employed,
Right.
so basically building up a kitty, a slush
Right,
fund,
that's
a
right.
separate revolving fund
Yeah,
over
right.
here, that would then pay the liability as they go up.
It's exactly the same thing as the pension system. Back in the 80s, you remember this whole time. Back in the 80s, there was an unfunded pension liability. When people worked for a town, they didn't match anything like Social Security does in commercial work. They didn't do anything until the person retired. So there was a huge unfunded liability in all the Essex County, Middlesex County, Worcester County systems, and it was affecting the bond rating of the state. So they ended up putting in a funding plan, and so by 2026, they're supposed to be fully funded. So So now, in your Middlesex County retirement system, there's 4 components to the assessment you get. There's the amount for the retirees, what they're getting while they're working right now. There's the unfunded portion of theirs, because they should have been funded already. Then there's the current employees' current costs, what you should be putting in for them if you were starting a system right now and funding them on a current basis. And then there's their unfunded part. So there's 4 components being funded. And that's why you'll see that the Middlesex County assessment will continue to grow, even if you just stay flat with your employees. They kind of back-end loaded it to get it to pass back in those days, so that they put a 4%, I think it's a 4% increase in it, no matter what. So that it's kind of got a little back-end loaded, the assessment, so.
They're actually gonna push that out another 10 years.
And then, yeah, because, yeah, is it gonna be 10 years?
And that's what, yeah.
Yeah, because of the valuations.
We've been getting hit about 10% a year, except for this year.
What was it this year?
Well, I think they made some adjustments associated with the 30 to 40 a year maybe, and as a result, we didn't get an increase.
Well,
Small increase,
Small
under
increase.
1%.
Yeah, if they had kept on a 30-year with the decrease in value of the assets, you would've got killed. I mean, that's why they're talking, that's why they pushed it out.
Mhm.
So, in my opinion, if you, the third category is, the second category is the people that just, first one funds it, second category is people just ignore it like the plague, IRS notice, they're just not even, they're saying it's a $10 million current year thing, I can't do anything, I'm just not gonna look at it. And then there's a third group that do something, that acknowledge it, and if they can put 100,000 in, or put something in, so that when the readers of the financial statement look at it, you can put in your disclosures that you understand that the liabilities, you put $100,000 or a number in, and that as times get better, we intend to address it, more aggressively, but at least something. And so I recommend that you accept the plan and try to fall within that third category that just does something. I know that it's impossible to fund $2.7 million, but.
You're saying fund it in the irrevocable trust fund?
Yeah, yep, that's what I think you should do, is to start putting it, because if you don't, then what we'll end up doing is, in the financial statements, we have a disclosure that we show what the liability is in the financial statement. Then we have a disclosure that says, here's what the liability is, and currently it was that 2.7.
Yeah.
We have phased in 2.7, and how much is in the plan right now, 0. And even if you put it into a stabilization fund, you called it an other post-employment benefit stabilization fund, we'd still have to show it 0, because that's not in an irrevocable plan. And that's part of the requirements in order to show it.
Right, so once the money's there, it's there, and it's not
Right.
going anywhere else.
Now, I say it's irrevocable, but I think that it's irrevocable to the extent that everything's subject to change to the legislature. And it's an other post-employment benefits trust fund, so that if something happened with new health care, that it changed everything, that you could still just use that trust fund to pay off a current year's liabilities and just not put it into your budget for a year. So it's irrevocable to the extent that it's supposed to be used for retirees' health insurance. It doesn't have to be 30 years from now, retirees' health insurance.
And again, you could probably tap into it for a current year employee, retirees' benefits, and wipe it out that way and not hit your general operating budget. too.
Exactly.
So
Yeah.
it's,
Yeah,
so
that's
it's
it.
not like it's totally untouchable.
That's right. Right. Any questions or any?
So two things. So you're talking about enacting this irrevocable trust fund.
Yeah.
Legislation, and then also advocating us get the retirees on Medicaid, because that certainly reduces the liability.
I think it's
Figure
worth looking at,
significantly.
I mean, most of the places I do have accepted that now. And you know what, I can't tell you the difference in benefits, because I just don't know. I don't know what that does to the retirees, but I think that it just, the secondary policy that you have
Yeah, it's less
can be
expensive. Right.
whatever you want it to be. And it's less, it just makes a partner out of the Fed.
Joe had I think, was raising his
Hey,
hand.
we set up an account for that 2 years ago, and it's
Yeah, but that doesn't set up, that's not considered a plan, and in order to be considered a plan, it has to be irrevocable, there's like 3 or 4 different,
There's gonna be some language attached to it?
yeah.
Okay.
Yeah, so just having it, you could have set up a stabilization fund. A lot of people at first, before the legislation was enacted, set up a stabilization fund or went out and got special legislation. If you got special legislation and it met the criteria of a plan, then it counted, but just setting up account for it doesn't.
Okay, I'll talk to you about it.
All right.
Continue. Okay.
Did you have a question too? Okay. The next comment has to do with the financial management system. I understand the conversion process is going pretty well. I mean, I've been through a lot of conversions, and some of them not so good, and some of them good. And from where when I was in doing the audit, point that they were at, I think that it's going along in a good process. It's a really good software, Munis. It's one, I tell people that if they buy Munis, it's probably the last software you'll buy, because it's very good. It's gonna be around for a while. A couple of softwares have come and gone in Massachusetts, and people have had to convert, but Munis is pretty strong in its environment in Massachusetts. And when I performed the audit, the treasurer's receipt module was purchased but hadn't been implemented yet. So I don't know where that stands right now, but even when it's implemented, the treasurer's receipts package only can post 2 entries. So if you collect some licenses and permits and run it through the treasurer's package, it will increase cash and it will increase the revenue account. But that doesn't work for the collectors stuff, for the things that have receivables, for motor vehicle, real estate, personal property. They require 4 entries. It requires the cash, the receivable, a deferred revenue, and a revenue. So it has to have those 4 entries attached. And so right now, when they post all these receivables and refunds for receivables, journal entries are required. So I was looking at it today, trying to figure out how many it means to them, and I'm thinking at least 30 a month. So it's gonna be, 300 or 400 entries a year that they're gonna have to be made, and all subject prone to error, because you have to go through the receipts, see what came in for the receipts for the month, then go through every warrant and see if there was any refunds for the warrant. And so it's just gonna be prone to error. So the collector's package is automatic, is when you bill, there's something tied to each person's bill. And so when it's paid, it makes all the entries. It hits cash, receivable, deferred revenue, hits the receivable, and it's much less prone to error. Now, I'm not saying this is gonna happen here, it happens everywhere, but I was just at a collector's office that has Munis, and I was doing some testing, and I asked them, what do you do if the outstanding list doesn't equal what the ledger balance is? What are your steps? And she said, what do you mean? I said, well, if there's a variance, what do you do? And she's had it for over a year, and she said, I don't know, that's never happened. So I was pretty impressed by that. So that's what I recommend. I mean, you've already put a significant resources into the Munis system, which I think was a good system. So I just think that, over the next period, as funding becomes available, that it's a good idea to look and get the collector's package.
This is, Joe, this is not the package that we have purchased but not installed?
Not the collector's.
That's the treasurer's, right, John?
You have the treasurer's package.
Yeah. But the collector's package does the billing.
Mm-hmm.
Right now, I think you're on you're on Point still,
Yes, it's point.
yeah, you're on Point software,
Yeah.
and it's not an
Well,
integrated system anymore.
I guess as a board, we'll expect our finance department to come forth with a proposal for capital expenditure for that package.
Right, that was gonna be the next phase.
The next comment is, has to do with the internal control also. Standards that have been adopted over the past couple